What I wanted to do is take you through a kind of first an introduction around a bit of a case for action around energy and the need for energy long term, then get into a little bit more around technology, and weave into that my previous job before becoming the global manager of chemicals technology was the vice president of CO2 at Shell. So I'll weave in the CO2 story throughout, because I think whether you think about CO2 or other environmental issues, those come into play as you look at our long-term energy needs. As we get into this, I'll put up the disclaimer slide here, and you can read through that. You've probably seen these before. And especially the ones around, anything that says something in here around future predictions or prices, that's not our job to predict the future, so we'll give some scenarios and what we think future might look like, but you're not going to see anything about future prices or anything like that if that's what you were looking for. And just, I'll give you a chance to look through that quickly. So we get started. So start off with what we call the 9 billion challenge, and it'll make more sense on the next slide. If you look at the population estimates, so we just recently hit the 7 billionth person on the planet, and projections are by 2050, it might be up to 9 billion. So if you think about that in context, that's adding another China and India to the world population. And so when you think of that in terms of energy needs, you start to get a sense for what the real challenge is in front of us. And not only the number of people that are going to be coming onto the planet, but also the standard of living that people expect as you as you gain affluence and your country starts to develop, the energy demand can increase. So it's not only the number of people, but then the standard of living that people anticipate. So when you start looking at energy, a lot of people just look in terms of today and what are the reductions you can make, but you really have to look with that lens of the future growth and then affluence going forward. And so this slide will make much more sense as I start adding the other countries. But if you look at kind of gross domestic product per capita, which is the x-axis in thousands, and then on the y-axis is energy consumption. So you can see the U.S. is around 300 gigajoules, and it's stayed fairly constant over this period, but it's, as you'll see when I add the other countries, it's all relative. So if you start adding other countries in, like Japan and Europe, you can see that as GDP has increased, energy consumption has increased per person, but still not at the level of the US. Then you add a country like South Korea, and it has a much different trajectory than other countries. Australia also starts to look maybe of approaching the US. And then the two bottom lines that just got added are China and India. So for us, the big question is, as these countries develop, gain wealth, affluence, which trajectory are they going to follow? Is it going to be a curve that looks more like the US, and that's where they're going to plateau? Is it going to be more like Japan, which is an affluent country but has done more around energy efficiency and transport and other things? It's a big unknown, but it will be a huge factor playing out in future energy needs. How those countries that are on the early part of the curve develop. Also for the US, does that blue line stay where it is now, or does it start to go down, or does it start to go up? So if you look at energy demand over time, this is where some of the predictions start to come into play. The energy demand, we think, in looking at some of the Shell scenarios, is that we think energy demand will be about double what it is today in 2050. But at the same time, if you put the CO2 lens on that, all the scientists and the studies indicate that we need to halve our CO2 emissions in that same time period. So you look at those two things start to play and start to show the need for technology and innovation because you can't have both. And the numbers around CO2, everybody talks about the 450 parts per million limit on CO2 in the atmosphere before you start noticing significant climate change. And we're, depending on what data you look at, we're close to 400 and about going up about 2 parts per million per year. So this isn't something that's out, 50 years, 100 years from now. The trends show that you're headed in that direction. When I was in Group CO2, we had started to do some analysis around when did we think the United States would become serious about CO2. And this was about 2 years ago, and we were on a whiteboard, and we were just kind of mapping different things out. And one of the things somebody put on the board is if a hurricane hits New York and affects the financial markets, then maybe the U.S. would become serious. And everybody laughed when we put that up on the board and said, "Oh, that'll never happen." And in the last year, there's been 2. So just goes to show that things can start to really speed up on you. Now, to get grounded a bit on where we are today, I think especially in the UK and a number of countries, we talk a lot about renewables and wind and solar. But if you look at the energy system today, basically 3/4 of our energy comes from hydrocarbons, whether it's oil, gas, or coal. On the renewable side, biomass is probably about 10%. That might be a bit generous. Renewables are only about 4%, and then nuclear makes up 6%. And I don't know if that 6% is pre or post the events in Japan, so it's probably a little bit lower. But that gives you a sense of where we are today. If you look at what sectors that goes into, mobility plays a big piece of that. So just over 1/4 of the energy goes into mobility, whether it's planes, automobiles, transport. About the same amount goes into residential, and then a big piece goes into agricultural and industrial. So I think it's good to keep that in mind as you look at the future scenario, because even if you look at some pretty aggressive targets, again, these are some shell scenarios that we've run through, and if you take a fairly aggressive look and assume that by 2050 you can get to about 30% renewable energy, that still leaves 70% that comes from fossil fuels. So, I think that just puts it in perspective that even with tremendous growth in the renewable side, fossil fuels is going to play a part of the equation, a large part of the equation for some time to come. And again, if you start to look at that in terms of what we've talked about before with the population increasing, mobility is important to keep in mind, because if you think about developing countries, what really enables them to continue to develop and grow, and it's a lot about mobility. So it's a lot about being able to get people to the jobs that are there. It's about growth. It's about, as the city expands, how do you get people to work? It's about the industry. How do you drive that going forward? How do you do the deliveries? So mobility plays a big part in this. And I'll keep saying there's this challenge on the CO2 side. So, before we talked a little bit about CO2 emissions from mobility makes up about 1/4 of emissions. If you keep going on this trend, and you don't do anything differently, it could be up to 80% of your emissions. So again, that dilemma that you have to face going forward. And if you think about then Shell's business, we're in this business, right? The mobility business. So this is a big issue for us of how do we address the opportunity around growing mobility and the growing need for our products. But at the same time, how do you do it in a responsible way that starts to address things like CO2 and the other issues that come up? And this is where it comes into, I didn't pick the title of triple trilemma. Probably was a bit beyond me, but it starts to show a little bit of the forces start to pull you in, because there's no silver bullet, there's no easy answer when you start to address parts of the issue out there. And where I'll start is on the left-hand side. And if you think about these three forces that are pulling you a bit, sometimes in different directions, certainly to grow your economy in today's environment, you need more energy. And you see that in China, you see that in other developing countries, where there's a strong pull for the energy into those countries. But at the same time, you have the other E in this three E's, which is the environment. And I've mentioned a lot about CO2, but there's other elements. Everybody remembers issues around SOx and NOx, particulate emissions if you have a lot of coal-fired power plants. There's a number of environmental issues that come into play in this 3E part of the triangle that you have to balance as you grow. Then you look at the other base of the triangle, and you have to think about the fuel that you're going after. Of course, has to be available. That's the key thing. Accessible. Unfortunately, if you look at a lot of the oil and gas reserves that are there, they're not in the most easy place to develop. So how do you get to them? How do you develop them? And then the third part is affordable. If the price to explore, extract, and transport the fuel is so high that you're going to price yourself out of the market, that puts the other pressure on that triangle. And then the other part is what we call the energy, food, water nexus. And I have a bit more information on this, but when you really think about these three pieces, they play off of each other. So you need water to produce energy. It's a key component, whether it's either in the upstream side of the business and extracting and bringing the oil or gas out of the ground, or in the processing. There's a big interchange between water and energy. The other way around, if you look at the needs for water, energy goes into that to extract the water and purify water. And then food plays a big part in this, because it's going to be the same competition for water and the same pull for energy. And then with biofuels, of course, you can go the other way, where you start getting some sugar, corn, and other things that normally would go into the food market that go into the energy market. So if you think about where innovation plays and where the challenge is, it really is kind of summarized in this triangle. How do you balance all these competing needs, the need for growth, the need for more energy, the constraints around the environment? How do you build into that pull on water, the whole food, land use? There's a lot of factors that come into play in your overall perspective of how this looks. And here's a slide that I mentioned that goes into this energy, food, water nexus a bit more. So if you look at energy demand as that goes up, a big issue around water and how you use water. Both, again, if you look at the large shale gas and captured gas that we're finding in the United States, requires a large amount of water to extract that from the ground. And then there's the whole processing piece that comes into play. Energy goes into a lot of water production. If you look at some Gulf states, probably 2/3 of their energy goes into desalination and other water purification. So there's a big pull on the water side of things. Food, again, energy is needed to produce food, and some of the food is now going into the energy sector. And then there's the same draw on the water side of things. So these are the things that really play, and you really have to get the right balance as you look into this dilemma going forward. So having said all that and kind of laid the case for change, so these are all the complexities, but if you're a technologist or you're an engineer or scientist, this is what now makes this exciting to go after. So what is the technology response, and how do we start to look at this in a different way? And I'll just give you some statistics for Shell. So in the period of 2011 to 2014, we're investing about $100 billion to go after more energy resources, whether it's gas, oil, other forms of energy. So a huge investment. On the technology side, for the last several years, we've been investing in technology at about a rate of $1 billion a year. Again, to solve a number of these problems that we've outlined here. So we see technology as one of the key drivers that are going to help us crack some of these problems that are going to be long-standing for some time to come. And as we go through this, I'll give you a little bit more, a few examples of how Shell's investing in technology to work our way through this dilemma. As I said before, if you look at the energy and energy requirements, growing population, growing affluence, you're going to need all the energy you can get. And so we don't look at it as an either or, that you go after renewables or bio or fossil fuels or nuclear. The scenario we see going forward is you need it all. Now, how that plays out and what proportions, I think, will change over time, but I think that's very critical. It's going to be harder and harder to find that energy. You know, the easy energy has, in general, been tapped. The crude oil that has low sulfur, easy to access, light, easy to process, those fields are usually pretty well explored and tapped out. Natural gas that doesn't have a lot of CO2 or H2S or other components, those fields, a lot of the national oil companies and others go after that directly, and you get the fields that really require a lot of processing. So if you look at the energy demand over time, it's going to be, again, if you think about the 3 A's, it's going to be more and more important to find out where it's available, accessible, and where you can actually do it in an affordable way. And so, as I mentioned, we really think that innovation is going to be the key to untapping and unlocking all these resources. So I'll talk a little bit about how we start to see this playing out around cleaner energy. And one of the most prominent examples I think that we can use is natural gas. I think everybody, when you think about the dilemma that we've outlined here, starts thinking about technology that might be 20 or 30 years out in the future, and what do we do then, and how do you start planning for that? Well, with the vast amount of natural gas reserves that we're now finding, natural gas plays a nice card in that transition because it's a much cleaner fuel. If you look at a natural gas fired power plant versus a coal-fired power plant, it emits about 50 to 70% less CO2. This isn't any new technology, it's existing technology. If you look at, I mentioned we found much more natural gas than I think we would have ever expected 5 years ago. And current estimates are that we have about 250 years worth of natural gas. And as we find more and more, you'll find same developments on natural gas. You'll start seeing some things around tight oil that comes into play, where I think a lot of the oil we thought was inaccessible you can now get to. But natural gas really is one of the key drivers for us. And if you think about Shell, I don't know what your view is, but I think probably most people think of Shell as an oil company. And either sometime this year or early next year, about half of our equivalent reserves will be gas versus oil. So we're a gas and oil company. We're not just an oil company. So it puts it in a bit of perspective, how much gas is really coming into play over time. And if you look at gas, I mentioned gas in terms of power generation. It plays a much bigger role even in areas such as transportation, so you can start thinking of gas in that sense. But then if you think about other areas that we play in, and probably most people don't start thinking about this, but we have a fairly large bitumen business, so we're into paving and asphalt, and we're developing a number of different asphalt and bitumen opportunities that allow for lower CO2 emissions as you're laying and producing the bitumen. An area that I work in, I'm the global manager for our chemicals technology. We're doing a lot of work on detergents that allow you to wash at lower temperatures. That's going to play out in a lot of different markets. I'm not sure if you know, but Shell's heavily invested in biofuels. We have a joint venture in Brazil with Cosan that allows us to produce biofuels on a fairly large scale. And the real push that we're looking for is what's called, if you hear the term second generation biofuels, that's the next generation. So just the key that I use is first generation biofuels are usually the feedstock is something you can eat, so it's either sugar or corn. Second generation is grass, wood chips, or all the stock that's remaining after you harvest the sugar. So these are areas that we're really looking to drive going forward. So you might start asking the question, why don't we move quicker? We've laid out this challenge. We need more energy. We have this increasing demand. We have constraints around the environment. But if you look at most developments in the energy sector, it takes about 30 years before you get to a point where you're just 1% of the global supply. So if you think about that, and you think about the slide I had before of trying to get to 30% renewables by 2050, that's quite an aggressive target. You might think that's not aggressive enough, but if you start thinking about this 30-year rule, and this isn't a rule of nature or science, it's a bit of rule of economics also. Most of the assets that we put into the ground, we invest $8, $10, $12 billion to put the asset in the ground. We want to make sure we can operate them for the next 20 or 30 years. We don't want to put assets in the ground that we're going to only operate for 5 years. And most of the assets in the energy sector and the chemical sector are going to be assets that have a long life. And so it really comes into play. Then you add on that the technology, so the time it takes to either come up with the idea, pilot it, and then get it out into the market. That's a long lead time. And then you build that, especially in the energy and transportation fuel, all the infrastructure that comes into play. So you think about your petrol stations and all the infrastructure around pipelines, trucking, other facilities. There's a lot of investment that goes in over time. So you can't really switch on and off energy supplies and what makes up your energy demand quickly. You really do see this 30-year horizon play out in a number of cases. So if you think about that and you look forward and how are we really going to drive this, I'd like to talk a little bit more about the case for gas. And this isn't just because now Shell is a 50% gas company. We really do see this as a real energy for the future. I talked a bit before about the 3 A's around abundant energy. Is it acceptable and is it affordable? I had mentioned this statistic a bit before. Current estimates are about 250 years worth of natural gas. Really, there's a lot growing in the northeast of the United States, but we found in China and other places there's a lot of gas reserves that we now know how to get after and develop. So you start seeing a much more abundant view on natural gas. I'd mentioned already around the efficiency of natural gas and CO2 emissions, so especially when you compare it to coal, much cleaner fuel, much more efficient. And replacing coal power generation with gas generation really gets a long way to meet whatever protocol you have on CO2 reduction. And then on the affordability scale, I don't know if you can really see this, but capital cost for gas turbines is really known technology, fairly inexpensive, much less expensive than coal. But then if you start comparing to nuclear and wind, big difference in capital expenditure that you have to pay for gas. So really see gas as a destination fuel, something that really is available now can bridge the gap and start to work on filling some of that gap going forward. And just a little bit about gas. So I'm a chemical engineer and work in the chemical side, so I'm not a geologist, so I'll explain this the best I can. But when you start looking at unconventional gas, it really comes in a number of different areas, and a lot of cases it's not easily accessible either. The porosity of the surrounding earth is so tight that you can't extract it, or the permeability is not there, so it really requires advanced technology. But we're actively going after this. Now, what do you do when you have all this gas? There's only so much power you can put into power stations and use as generation. One of the things that Shell's a leader in is gas to liquids technology. So this is taking natural gas and converting it into products that normally are derived from oil. And I'll have a slide that gets into that a bit more. And if you've been reading the papers, in 2010, 2011, we started up the largest GTL facility in Qatar. And I've got some amazing statistics, but it has a fairly large capacity and really producing a range of products from diesel to naphtha that's used in the industry, which normally would come from oil. And one very interesting development we're working on now is what we call FLNG, so floating liquefied natural gas. So this is the concept of, rather than going to a gas field and building a big liquefaction process right there at the field, you tap out the supply in 10, 15 years, and then you have all this asset in place. We now are developing floating rigs that will go from site to site. So it's a pretty amazing rig when you think about the size and the complexity of the processing equipment that is now built on a ship. So even if you look at the simple issues, like now that you have the LNG in the ship, how do I offload that and take that to a customer? And how do I do that in cyclone conditions? How do I do that in various conditions? Just the dynamics that go into play to get this to work are pretty amazing. And even the shipbuilding technology, when you have this much equipment on top of a ship, if you think about all the, makes it a fairly top-heavy ship, and how do you build a ship that really can sustain this over time? But we've taken final investment decision for this, and first application will be in Australia with a fairly large gas field in Australia. So again, an area where technology really is coming into play for Shell going forward. I won't go into this in a lot of detail, but if you look at the natural gas plays that are out there, I had mentioned tight gas, which is a big play that's in the U.S. There's also shale gas that comes into play with a lot of shale geographies. And then within coal, there's a lot of methane that can also be extracted. One of the big issues with the coal-based methane is the amount of water that also comes with it. So for chemicals engineers, a big separation technology issue there of how do you separate the gas from the water. I talked a little bit before about the 30-year horizon. So just to put a little bit of data behind that, I talked about GTL in Qatar. And just to show you the timeline for this development, it started in 1973 in our lab in Amsterdam, where I work now. And at the bench scale, you're talking about grams per day. So it really is the early start of gas to liquids technology. It took about 10 years to get to a pilot plant stage. So you move from the grams per day to barrels per day, but at 3 barrels per day, not a huge number. But really starting to test that technology and get it to kind of the pilot plant scale. And then in 1994, we built the first GTL unit in Malaysia, and the capacity was about 14,000 barrels per day. So even to get to that point, you're talking about a 20-year development period. And now the Pearl GTL plant in Qatar, in 2011. And you can see the massive scale up from 14,000 barrels per day to 140,000 barrels per day. But again, it just shows you the time horizon that some of these huge developments come into play. And to give you a sense of the size of the Pearl GTL, the last that I read, I think the total investment between Qatar and Shell was in the order of 18 or 19 billion dollars. So not a small investment, a huge investment for Shell. And if you look at the amount that was invested in that technology over time, it was fairly significant. A little bit about GTL and the GTL plant. As I mentioned, you take natural gas, put it through the feed prep, and then put it through the GTL trains. And you end up with a wide range of products that, again, typically come from more of a liquid feed, from naphtha all the way to base oil, with a lot of different applications. As I mentioned, we spent a number of years investing, so this investment of $500 million is really just getting it to the stage where you can build the plant. The plant itself dwarfs that investment by a significant amount. Yearly spend was in the $60 to $100 million range. And again, just to give you a size of the technological challenge, about 3,500 patents were applied for and granted for GTL. And on the order during that time frame, 80 to 100 people constantly working on the GTL development. So that gives you a little bit of a sense of the investment and why this 30-year rule comes into play to really drive something to this point as you go forward. Now, if you look at the kind of the payoff, I'll give you just some statistics around. I'll go here. Go back. Some statistics around Pearl, and I'll have to read these because I think it's amazing. So if you look at the gas field in Qatar and the lifetime of the Pearl asset, estimate is that it's going to be about 3 billion barrels of equivalent oil over its lifetime. So it's a pretty huge investment and a pretty huge output. It's about 8% of Shell's worldwide production now, if you look at just that one investment. And if you look at the overall development, it's the single largest gas field in the world, and really now taking that and turning it into more liquid products going forward. So a case where big investment, big bet, but also big opportunity playing out over time. Another interesting thing, and this goes into play a little bit around the food, energy, water nexus that I had talked about earlier. If you look at Pearl, it's based in Qatar, where most of the water comes from desalination, so water's at a premium. But one of the interesting things about the GTL process is it produces water as a byproduct. And so our objective for Pearl is to completely close the cycle, so to make sure that all water consumed and produced is used within the process. So we're not going to tap into any of the clean water either through desalination or some of the water aquifers. It's going to be all self-sustaining. So all the byproduct water that's produced as part of the GTL process will be the water that's used to continue to run the process. And I read even something where all the plants and bushes and grass that were planted around the GTL plant also come from the process, so it really is fully sustained. But again, it's this kind of technology and thinking about how do you really play this energy-water interface and really drive it going forward. I think this plays out in what we're doing today. I think is a good example. Now, an area that's close to my heart, if you think about most oil production, and you look at just kind of normal technology that's used to extract oil, only about 35% of the available oil actually gets extracted. The rest of the 65% stays in the ground because you just can't extract it due to the geology, and also the nature of the oil. So a large percentage of even oil fields that we find now, you only extract a small percentage of the oil that's in place. So one area that we're working pretty heavily on now is enhanced oil recovery. So this isn't a case where you're trying to go and find new reserves. You know where the reserves are, you know the oil is there, but how do we extract more of that oil from that reserve? And for a long time, there's been steam injection, CO2 injection, and other technologies to get more of that oil extracted. One of the areas that we're working fairly heavily on now is surfactant and polymer-based extraction. So part of the chemical business that we support makes detergents. And if you think about detergents, laundry detergents and others, the whole purpose of it is to break up the oil and other soil that's on your clothes or on your dishes and take them away from the fabric and then wash your clothes. Well, that's what you really want to do in these reserves, right? You want to take the oil that's in the ground and provide a method where it can more easily be extracted. So we're using that surfactant technology to start to allow us to extract more of the oil that's in the ground. You can also use, most of these is a combination of surfactants and polymers along with steam. So it's a very interesting mix of different chemicals and steam that you use for each oil field, and each oil field is going to be different. But we're thinking that even with technology that we know now, that out of each field we can get about 10% more oil extracted. So that's might not seem like a lot, but if you think about that's a big improvement over the 35% that comes out now. So again, an area where a company like Shell that has both a chemical division plus the upstream oil and gas division, you combine those technologies together to get you, allow a breakthrough in your oil processing. This goes into a little bit more detail. I won't bore you with all the chemistry and the trade names for our surfactants, but you really start with a typical oil field. There's usually, first thing that you do is some kind of steam injection or flooding that starts to drive the oil to the producing well that extracts that as either the field ages or there's other factors that come in place. If you start to inject steam, CO2, or this surfactant polymer mix, you start to increase the amount of oil that can flow through the reservoir and into your drilling apparatus. So again, a big opportunity for us to extract more oil and not have to find new reserves. I'll switch gears a little bit now and talk about carbon capture and storage. I've talked a lot about the technology that goes into finding and extracting oil, processing oil, but we think carbon capture and storage is one of those technologies that is going to help meet the CO2 challenge that's ahead of us. And this really can play out in a number of ways. One, it can play out in gas fields where you have a gas field that has a fairly high CO2 content. So there's a number of gas fields that are out there that, believe it or not, have about 50+% CO2. So it's not just the burning of the gas that you have to worry about CO2, it's actual CO2 content in the gas as you take it out of the ground. And so you have to extract that CO2 before you can ship it in a pipeline. Or you can talk about post-combustion. So if you have a gas plant or a coal plant, how do you take the CO2 that's going to be emitted that would typically go out the stack? How do you separate that CO2 from the effluent, capture it, and then sequester it? So I think carbon capture and storage is going to be a big issue going forward and something that will enable us to meet some of our CO2 targets. Within Shell, we already have a lot of investments going in place. In Australia, we had mentioned the LNG project going on. We're going to have a large carbon capture and storage plant that's associated with that, and I have some statistics here if I can get to it. So in Gorgon, we're going to put in a CCS facility that can capture 3 to 4 million tons of CO2 and sequester it. So a huge improvement in your CO2 footprint. We've invested in Mongstad, which is a demonstration facility, so it's really much more of a research facility for us to test different capture technologies and drive that. And then, I haven't mentioned this yet, but in Canada there's a lot of oil sands where we're extracting heavy oil from, and to significantly reduce the carbon footprint of the oil coming out of the oil sands, we have a CCS project that we've approved to extract up to 1 million tons of CO2 per year from that venture. And if you think about that, it's about 35% of the CO2 that will be emitted. But for me, the more important statistic is that's about the equivalent of 175,000 cars you'd be taking off the road in the US. So it starts to give you a sense of the amount of CO2 that you can start taking out right at the source and not have to worry about it getting into the atmosphere later. So CCS we see as a long-term play. Just to give you a little bit of a sense for where Shell is, our objective isn't to be the leader of CCS technology. We're investing heavily in it, but we're also working in a lot of consortiums because we think this is an industry issue that all of the oil and energy industry should be involved in. So you'll see a lot of these are joint ventures with Chevron, Statoil, a number of other companies that we think are also interested in CCS and will continue to develop. Also CCS, especially in the UK and other places, gets a fairly high amount of government funding. So the government's also promoting CCS as a way to reduce the CO2 footprint. This is a bit of a summary slide, and to me the key point on this slide is to say that there's no silver bullet. You can't, out of all the technology opportunities that we see on the horizon, you can't say that gas is the item that's going to fix it all. Biofuels is going to fix all the issues. Solar, wind, anything. It's going to be a mix of all these technologies that are going to play out over time. So on the fuel side, I think all options are on the table around hydrogen, e-mobility, fossil fuels. You see a lot of countries are developing renewable fuel mandates. So in the US and most parts of the country, there's a requirement that you have 10% of your fuel is ethanol based. You see that play out in a lot of different countries. Different countries and regions will choose different portfolios. Brazil is very big in biofuels, and most of their cars can actually operate on 100% biofuel, which isn't always the case. And that plays into this a little bit around drive chains. And then, there's a large base. I talked a little bit before about the 30-year infrastructure that's in place. If you think about the amount of cars that are on the road, the whole infrastructure that's in place, it just shows that it's not going to be a change that comes in overnight. It's something that's going to play out over time. So again, this really shows that it's going to be all of those things that play together. Now, talk a little bit about biofuels. I mentioned Shell has a fairly large investment in Brazil around biofuels. You really do see the value of biofuels in CO2 reductions, diversification of energy, and also it's fairly easy to integrate with existing infrastructure. A lot of biofuel that goes into fuel is mixed with existing fuel sources, so pipelines, other transportation methods are already in place. So biofuels is one of those that's fairly easy to integrate. And then in places like Brazil and others, there's really a big development opportunity for them to take advantage of that. But I think the key, when you look at biofuels, and we've done a number of studies on biofuels, they're not all created equal, and you really have to be careful as you start to study the biofuel and where it comes from. If you count the amount of energy that goes into planting, watering, harvesting, cultivating, fertilizer, processing, you really have to make sure you take that whole envelope into consideration. early biofuels, some of the processes that were in place, especially the smaller scale, were actually energy negative. You put in more energy than energy you got out. So you really have to be careful how you draw that boundary and start talking about it in scale that's big enough to really start driving you into the positive category. And the other thing, I had a previous manager that always used to say, do the doable now. So one of the keys for us is, again, you can look at all these future technologies and where they're going to head. But one of the things we can do now, and Shell is investing heavily now, is we can be more efficient with the fuel that we're already using and producing. So energy efficiency and driving energy efficiency not only in our upstream processes, but in our refining and chemical plants is a big drive that you can do right now. It's known technology, and it's just a matter of doing it day in, day out. Same with your transportation, so your vehicle, same with the residential consumption. Efficiency has to play a big part in this. And you can really get to a lot of our energy reduction demands, CO2 reduction demands through energy efficiency. And it's another area where technology really does play. And so, summing up, and I'll leave some time for some question and answers. You know, if you think about it, we really do need all the energy that's out there. Even if you take some of the aggressive projections around renewables out into 2050, you're still going to have a very large portion of the energy that comes from fossil fuels. How we play out those that trilemma of those different factors that come into play is going to be important, not only in how we meet the demand, but also the type of lifestyle people have, what their energy future looks like, the level of development that each of those countries can go after. And I think it's going to be really crucial to understand how all those factors come into play. If you start just focusing on one, whether it's economic development or water or food, you really do miss the big picture. And for me, it's the way technology plays into solving some of those dilemmas that's going to be the real future for closing the gap long term. So with that was a lot of talking. So wanted to open it up for, I think we have some time for questions and answers. There's a lot of challenges as you look at the second generation biofuels. If you look at first generation, it really follows processes you know fairly well and nature has been using for years, and it really does show that. Second generation biofuels, we're investing very heavily in to try and break that technology because it starts to solve a number of these issues. When it's at that point where it's kind of commercially viable, I think my default answer would be that 30-year scale. If you look at it, even first generation biofuels has taken about that 30-year time frame. Second generation biofuels, we've been working for 10 years, but I wouldn't bet against the 30-year curve anytime soon. So what really drives the gas to liquids technology is twofold. One that you mentioned, the demand side is very heavy for the liquid fuels, and with the amount of gas that's available, you can't put it all in one sector. You have to start looking at what other sectors can you put it into. But one of the biggest drivers, if you look at the price differential between natural gas and liquid fuels, it's huge. So if you did it on a energy equivalent basis, the price of natural gas should be much closer to oil right now, and it's not. So I think natural gas is in the $2 to $3 per million standard cubic feet now, and oil price is still, depending on what day it is, 100 plus dollars per barrel. From an energy basis, that doesn't make any sense. They should be much closer than that, and so that oil-gas differential is another big driver that's pulling gas into the liquid market. Yeah, so I used to manage a group that did economic evaluations on a number of processes. And I think one of the things that we learned during that is there's a lot of good opportunities, whether it comes from sewage, there's a lot of methane gas in municipal dumps, other places that you can really go after that. For Shell to really be interested and to really drive for that, you have to start thinking large scale. So for us, I talked about the Pearl GTL, which is huge quantities of fuel that'll start coming available. So we see the value, we see the margin uplift, but we struggle a bit with the scale. And really, is it going to be an area where Shell's expertise can come into play in developing those smaller fuel opportunities? We're much better at dealing with large governments, large projects, and that's where our expertise mainly lies. So do see the value, do see the margin, and see a lot of the opportunities, because if you look at whether it's sewage or it's municipal waste or other areas, it gets a little bit away from the logistics issue, because usually there's a large city near where these opportunities lay, let's put it that way. And so you really don't have transportation costs, and you can start looking at some distributed models. So I do see the value in it. For Shell, sometimes it's a bit questionable if you can start getting to the scale where it starts to make a lot of money. Big enough for us to say that's the opportunity we'd go after. We're doing, looking at carbon capture and storage for both CO2 capture at the source, so from the natural gas, but we're also looking at post-combustion technology. So it would play in the coal industry or in a gas-fired power plant. It would play in refineries and chemical plants. So we are looking at the post-combustion CO2. The issue starts to become cost, as with any new technology that you're developing. If you look at a gas field that's in play, the economics start to make a little bit more sense up front, because you're going to have to remove the CO2 from the gas anyway. And so that's a part of the cost that's already going to be paid for. Post-combustion technology, you're talking about a much smaller percent of CO2 in a very large waste stream, extracting that in a large enough quantity, and then paying the injection. Again, with a gas field, you're usually near a reservoir that you could probably inject from. A coal plant, there might be a reservoir that you can inject to, but you might have to pipeline it. So there's a lot more technology challenges, but we are looking for things that you can attach to either the back of a gas plant or a coal plant. As a chemical engineer, anytime the solution that involves carbon is either flaring it or injecting it, doesn't feel right. There's a valuable carbon molecule that you're not taking advantage. And we are looking pretty heavily and investing in, can you turn the CO2 into something useful versus injecting it? On the CO2, if you can inject it and get more oil production, that's one thing. Right now, the big challenge on turning CO2 into a useful chemical is economics again. The laws of chemistry and thermodynamics are working as against, because CO2 is a fairly stable molecule, and getting it to a point where you can really, again, at a large scale, manufacturing something useful. We're working on it, but it's again, one of those innovation challenges. It's a little bit difficult. So this is one where I'll give you my personal opinion on this one. So I think with most technologies, there's a right time to do it. And if I look at the cost, and you look at the amount of natural gas and other much more reasonably priced and viable opportunities there is in technology right now. If it was my money, I know where I'd invest it, and I'd drive that. Now, to be honest with you, energy policy isn't always driven by logic. So there's a lot of things that come into play around government mandates and regulation, and part of it is good because I think it helps drive technology and innovation and development. But from an economic perspective, if you're the one paying the electric bill, you have to start questioning how much am I subsidizing something that's going to be much more expensive. And so I think you have to think of it both in terms of a bit of it is an R&D tax and a bit of it is maybe more politically driven than economically driven. So I guess I'd make a few comments. So one interesting thing about the U.S. right now is it's now a net exporter of natural gas. And so if you look at all the reserves that have been found on the gas side, it really has changed the picture. When it comes to oil sands, for me, I think the key to driving things like oil sands and other things to be competitive long term is understanding what the end use is going to be. So right now, California, for example, has put into place a fuel standard. So any fuel that goes into California has to meet a certain CO2 requirement. And that drives you to do things like CCS for our oil sands operations in Canada. And even there is still competitive economically. So I think there's responsible regulation that you can put in place, and once the industry knows that, then you can adjust that and drive that forward. And I think in the case of the oil sands, we're doing that by doing the CCS project. Now, at a certain point, economics always come into play, and the oil sand still is a very economically viable. It's getting much more efficient long term. So. What's the role in government? I think each government can either put the regulation on end use or on the technology, and then we have to respond to that.